Good morning, everyone. This is John Shaw, the director of the Paul Simon Public Policy Institute at Southern Illinois University. Thanks for joining another installment of our series, Understanding Our New World. And today we're very privileged to be joined by Jim Bullard, the president of the Federal Reserve Bank of St. Louis. President Bullard has impressive and actually impeccable Midwestern credentials. He was born in Wisconsin, grew up in Minnesota, attended college in Minnesota, went to graduate school in Indiana, and then he moved to Missouri to spend his career. And I'm sure along the way he's passed through Illinois a lot because his district covers a good chunk of our state. The president joined the St. Louis Fed in 1990 as a research economist and rose up through the ranks and was elected president in 2008. He is well known in the St. Louis communities, involved in about every civic organization you can imagine. Also does some economics teaching at WashU. I think he's also an advisor to the economics department there, and is just a real stalwart in the St. Louis community and is joining us from St. Louis today. So President Bullard, good morning, and thanks for being with us.
Good morning. Thanks very much, John, for having me today.
Great. Well, let's just talk maybe briefly about your sort of grounding in economics. You studied, I think, at St. Cloud State in Minnesota. And as I was looking at your resume, it seems it was pretty quantitatively oriented. And I'm just wondering, was your initial interest in economics, sort of kind of the practical day-to-day aspects of economic life? Was it economic theory? Was it just kind of a combination? How did you get pulled into the economics profession?
Yeah, as an undergrad, I had a double major in what was called, one major was called Quantitative Methods and Information Systems. So that was designed to combine computer science and business. So I had some computer science, and then also my other major was economics. And so the vision was to try to put those two things together. And more or less, I would say that's, been my research career. To try to carry that out. I love economics and ideas in economics, and I've always liked the computer science aspect. A lot of actual research is actually just programming, so if you know something about it, it's helpful.
When you entered the PhD program at IU, were you thinking maybe of an academic career, or was it just a way to kind of, hone your skills and really deepen your knowledge? What were you thinking when you went to grad, pursuing your doctorate at IU?
No, very much, those programs, like all of them across the country, are very much oriented toward academic careers. I joined the research staff here. Being a member of the research staff here is very much like being in an academic position. You're expected to publish in leading journals. You're expected to have presence and get cited in the profession. And, I managed to do all that. I've sometimes said it's the worst job at the bank because you're at the mercy of these journals, whether they'll publish your stuff. But it's a lot of fun too, and you really get to push hard on the frontier of economics.
So when you joined the bank in 1990, were you thinking, this might be a good way to launch my career and kind of move on to something else? Or was it pretty early on clear to you that this is where you wanted to spend the bulk of your professional career?
Yeah, I joined the bank in 1990, and within a year or two, I was FOMC Class 1, which means that I was advising the president on monetary policy. And so I've been involved at the FOMC level ever since then. That's a long time. It's a lot of meetings. I've always liked to have a sort of one foot in what's going on in macroeconomic theory and one foot in how can you apply that to the real world and actual policymaking. And I've been in an ideal position to do that.
Well, let's talk just for a minute for our audience about the structure of the Fed, so they kind of have a grounding. I mean, we had the Board of Governors in DC, a 7-person board chaired by Jerome Powell. There's 12 regional banks with presidents. 4 of them, interestingly, are from the Midwest, which I suspect has something to do with the power configuration in Congress in 1912 when the Federal Reserve Act was being assembled. But tell us, and then of course you have the FOMC that you referenced, the Federal Open Markets Committee that meets every 6 weeks or so to talk about the economy and interest rates and so forth. So tell us how the regional banks, as you see it, fits into this structure.
Yeah, this is the third attempt by the United States to have a central bank. The first two attempts failed. The first bank and the second bank of the United States both failed. You may vaguely remember, or your listeners may vaguely remember American history in that Jackson era, the Andrew Jackson era. He campaigned for president partly on abolishing the second bank of the United States and was eventually successful. U.S. did not have a central bank from then up to the Civil War and all the way up till the eve of World War I. But as the country grew and became more complicated, contemporaries became more and more frustrated with the periodic panics in financial markets in the U.S. And the sense was that we had to have a better system. And after the panic of 1907, that's the one where J.P. Morgan had to write a personal check to try to bail everybody out. Then they said enough is enough. Even the stalwarts said enough is enough. We have to do something. But the question was, what should you do given that the first two attempts at a central bank had failed? So they came up with this idea that you would decentralize the central bank across the country, and you'd allow input on these important decisions from all across the country, from Main Street America, if you like. And that has turned out to be a brilliant innovation, I would have to say, as many things have happened in the last 100 years plus, but the central bank has been able to continue to provide as good a policy as we can through that entire era, and including right through the current crisis. So I think the regional banks have played a critical role. That the original act was carefully crafted, if you look at it, to try to balance the inside the Beltway versus the New York Fed, sort of the Wall Street part of the Fed, with the rest of the country. And our role is to play our part as well as we can and get the input on monetary policy as best we can for this part of the country.
Well, how would the day-to-day responsibilities and work of a Fed president, such as yourself, differ from like a board of governors in DC? Clearly you're meeting with business people and you're traveling the district and you're seeing where the rubber meets the road. And I presume that's the theory, that you would be, exposed every day to the practical evolution of the American economy. But I mean, in terms of day-to-day responsibilities, do presidents and governors tend to see the world slightly differently?
Yeah, we actually have a governor, Chris Waller, who was the research director here and is now the governor. So he's learning that the job is different from my job. The governors have oversight responsibility for the system, but most of the employees are at the banks. And so what has happened over time is the banks have specialized in certain activities. The cash product office is run out of San Francisco. We run the Treasury Relations Support Office here. Retail payments is out of Atlanta. So the different banks have different responsibilities and have teams to run those businesses. And so we do that. The Board of Governors doesn't really do that. They have oversight responsibility, and they actually make the regulations for the financial system. That is not done here at the Reserve Bank. So we implement those regulations, but they're actually made at the Board of Governors. So they have a bigger policy portfolio on the regulatory side. So it's a complicated mosaic, but I would say the general picture I would leave with this audience is that there's been a lot of specialization among the different banks, and appropriately, I think, over the last 25 years, and that they've, we've taken on responsibilities to run certain businesses. So for my job, what this means is that, I'm CEO. We have to run these businesses and do it well. I'm also a policymaker with my role on the Open Market Committee. So, and that's a very time intensive kind of thing. You're tracking the economy, including the district economy all the time. And I'm also a system executive. So I'm working for the entire Federal Reserve System. This year and next year, I'm the head of what's called the Conference of Presidents. So you're doing things at the system level as well. And so lots of dotted lines and interesting business issues to deal with.
Well, let's talk for a second about the 8th district, which you are leading. And it has branch offices, I guess, in Memphis and Louisville and Little Rock, as I understand it. In pre-COVID times, would you sort of get around the district as much as you could and meet with folks? Or, I mean, obviously you can talk on the phone and so forth, but I mean, how do you keep a pulse of what's happening in the 8th district?
We have an extensive engagement strategy to try to keep in touch with all parts of the district. There are many elements of that. We have councils. We have we might talk to people one-on-one. We might reach out to different people. We have branch boards of directors, which are excellent and give us a lot of input. We try to maintain contact with all these different business communities by having key people from all over the district participating in these various activities. And it's really, I would say, fun to hear about people and their businesses or their economic situation, because we also talk to community development groups and others that are trying to help low and moderate income communities. So it's a pretty extensive outreach program, and it's a lot to keep track of. We have a good team here that tries to do that, and we just try to keep touch with the entire district that way.
Well, let's talk about the American economy and COVID. And I guess maybe the first question, I get our first reported cases were, I think, in late January of 2020. When in your own personal situation did it kind of hit you that this was going to be a major seismic economic event? Was there a sort of a flash moment or two where you're like, okay, this is going to be something very, very different?
It was certainly on the radar screen as early as January with reports out of China, and then maybe about the first week of February, second week of February, a more intense kind of situation where Wuhan had been shut down and Chinese New Year had been more or less suspended. We get paid to worry. So we look at a lot of things like this that are going on, all the time. And you're always kind of wondering, which, I suppose, like being in the news business, you're always wondering, which one of these, will actually materialize and turn into something really major. So we're often watching things like this. But I would say the initial thought on this was, well, we had the Sars epidemic in Asia previously, and then for that one, it didn't go outside of Asia. And you also had MERS, which is related to what we're experiencing today. Both of those are related, but they didn't spread. So we're watching it very carefully with some concern. I remember being in New York and talking to the New York Fed staff, and we were kind of kicking scenarios around and saying, well, maybe you get a case here in New York or something like that, and maybe that would be downside risk. And I remember assessing that in particular on that particular day. Now, as it turned out, it did spread and obviously turned into a major pandemic. The FOMC in particular, I think, really mobilized. Things started to move very, very quickly. And on March 15th, we met off cycle on a Sunday. We actually had a scheduled meeting for that Tuesday and Wednesday, but just to show you how fast things were moving, that wasn't soon enough to have the meeting. No, we're going to have it on Sunday and get it all done on Sunday. So, and then we'll announce where we are before Asian markets open on Sunday. That just shows you how fast this was moving, and I think how resolute Chair Powell was in responding as forcefully as we could, as soon as we could. And so I think we got the right alignment of policies at that point.
Now, did the Fed have an array of contingency plans? And did they even have maybe a pandemic specific? In other words, that President Obama had a unit within the National Security Council that was a pandemic response and had a whole series of protocols. Did you go that granular, or was there just various contingency plans based on the anticipation of economic dislocation?
We do have contacts with the NSA and other parts of the security apparatus, so we do get some intelligence. For us, though, it's really okay, but is this going to affect the economy? It's not the military aspects of that or the intelligence aspects of that, but this one. It became clear right away that this was going to be a big hit initially to the economy, much bigger than we're used to for ordinary sort of recessionary type shocks. This was a huge impact because in the people in the high contact type industries, really were being asked not to go to work right on the spot. So you had the immediacy of it and the fact that, upwards of 40 million or 50 million workers who were in those kinds of businesses were really out of a job right then. And the businesses were shut down right then. So now, as it turned out, we were able, the economy as a whole was able to adapt. And that, I've argued, had to do with once the initial shock wears off in the first 10 days or month or so, you start to think about, okay, now we've learned a little bit about what the disease actually is. And now some businesses were able to figure out, okay, well, I can follow the safety protocols and still get some product out the door. And you got more and more of that kind of adaptation as you went through the May, June timeframe. That's why the economy surprised so much on the upside during the third quarter and really fourth quarter, and really all the way through the first quarter. It's because American business was able to adapt to the situation. Yes, we want to keep people safe. We want to keep customers safe, workers safe. But for a lot of businesses, they were still able to produce. One of the main things is work from home, and we did that as a bank, but there are many other aspects to that where you really have to manage, really have to hustle and manage, but you can get your product out the door and still run your business. For some businesses, that's not been possible. It's just too much. Movie theaters are sort of the poster child for that. And for them, you got to get the pandemic behind you before you can really get back to business.
You have said that the macroeconomic response, which is both fiscal policy by Congress and the president, and monetary policy by the Fed, has been, played a really important role in keeping the economy stable. Let's start out with monetary policy. As you said, you met, I think, first, maybe March 3rd, and then March 15th, with some very, very aggressive programs, interest rates near zero, lots of lending programs. As you look back, what programs that were launched during that time were especially effective? It's probably perhaps too soon to do an after action report, but from your vantage point now, what worked especially well on the monetary front?
Yeah, we lowered interest rates right away, but I don't think that it was clearly the right thing to do, but I don't think that had the big impact. This really wasn't about being able to pull future consumption to today or even investment to today. That isn't really what you wanted to do in this situation. But I think that the partnership with the U.S. Treasury and the ability to provide backstop lending programs through 13.3, part of the Federal Reserve Act, as modified under Dodd-Frank, that was really powerful. And the fact that we did that alone eliminated the incipient financial crisis that could have occurred on top of the pandemic. And I think it's really clear if you look at the data. The St. Louis Fed has a financial stress index. You can look at ours, which is the best one to look at, but you can look at the Goldman Sachs or any of the other ones. They all move together. It went up to a level of financial stress that was close to 2008 levels. So, and 2008 was off the scale. So you really had a tremendous amount of uncertainty in financial markets. They weren't sure what was going to happen next. They weren't sure if this would turn into, frankly, there was a global depression sort of possibility being priced into markets at that moment. But if you look, once we had brought the lending programs online and really just the announcement that we were going to do so much, the financial stress came way down, back down to normal levels by the third quarter. And people got a lot more comfortable with the idea that there's going to be plenty of resources to get us through this, and that we would be able to, they got more and more confidence that we'd be able to get through the pandemic and get to the other side. And now we're almost there. We still got some risk and some way to go, but hopefully we can get this behind us.
About a year ago, I guess it was maybe last April, Chairman Powell said that, that he was talking about all that you've done in terms of lending to an unprecedented extent. He says, we'll continue to use these powers forcefully, proactively, and aggressively until we are confident that we are solidly on the road to recovery. Do you think we're just a little bit short of that road as you see it?
Well, my reading of the pandemic data is that it's very promising for the U.S. At this point. And if you look at, I think probably the most important metric is deaths per day per million. That has come down dramatically from where it was in January, and is, hopefully is going to go even lower in the weeks ahead. And if you look at other parts of the world, they're maybe not doing as well. So I think you've still got that consideration out there. I've tried to stress that the European situation is not as good as the US. They've had more trouble with their vaccine rollout, I think somewhat surprisingly for markets. And so that's been an issue. But if for the US, it sure looks like this vaccine strategy is effective, and it looks like we're going to get a lot of people vaccinated very quickly here in the weeks ahead. And also you've got the skewness in who's most vulnerable to the disease. So you're able to vaccinate those that are most vulnerable first on the whole. And then hopefully that will push fatalities way down to a low level. I don't think we're quite there yet, but we're making a lot of progress every day. I think the production of vaccines looks very good for the U.S. And so it sure seems like this is successful. There are risks, and I'd be remiss if anytime you're in a crisis, you have to say, appropriately. I think that, the crisis can take twists and turns. That's the nature of a crisis. And, you might get news 10 days from now that really surprises us and sends things in another direction. But the trend is definitely very good for the U.S. And that's why Wall Street, which always looks ahead, financial markets are always pulling things forward. They're projecting a boom for the U.S. economy for 2021. And that's because they're doing the math in various ways, and they think we can get vaccinated and put the pandemic behind us.
Well, in broad terms, from the Fed's perspective, are you thinking of kind of doing more, just kind of sitting tight, or is there already talk about, okay, how do we kind of carefully unwind some of these programs? Of these kind of three broad scenarios, what seems most most prevalent in your thinking now?
Well, I think we have a great policy in place for right now, and we are looking forward to the end of the pandemic, but it hasn't happened yet. And I think the appropriate stance for any policymaker is to say, well, let's see if we really end the war. And if the war really does end, then we can think about what the next steps are. But you wouldn't want to be pulling back while you're still fighting. And I think that's the situation that we're in right now. We are anticipating that it will be a boom year for the U.S. economy. We are anticipating that the pandemic will come to a close through our vaccine strategy, but it hasn't happened yet. And so I think keep the policies in place until you get farther along here, and then as the dust settles, we can open up a conversation about what to do next.
Well, a big part of the U.S. response, of course, has been fiscal policy, spending, taxes, and so forth. And I think you've said too that the Congress and the president have been extraordinarily aggressive. I think numbers vary, but something like $6 trillion in stimulus. And I think I started out as a budget reporter, and I remember the first Clinton budget I covered. The entire budget was 1.3 trillion. This is 93. This is the Defense Department, Social Security, Medicare, Medicaid. I think the Obama total budget his first one was like 4 trillion. And I think this year we're going to have a deficit of something in the order of 3 trillion. So, I know you've said that this strategy has been very effective, and I think you say keeping households whole, keeping people, in place. So talk about fiscal policy in the big picture. I mean, have we responded at the scale that's appropriate, do you think?
I think that fiscal policy has been exceptionally effective for this shock. And so let me just talk about that a little bit. I think, as I said earlier, the nature of this was that you had tens of millions of workers, and you basically had to go to the worker and say, I'm very sorry, but because of this public health situation, you're not going to be able to work. And we're going to have to ask you to stay home while we're trying to deal with this problem. But don't worry, we're going to keep you whole, through this process, and we're going to keep you able to pay your rent, able to maintain your lifestyle, able to pay your bills while you're waiting out the pandemic and seeing if you can get back to work after the pandemic's over. So what did we do as a nation? We went and borrowed on international markets and chaotically a little bit, but handed it out to these disrupted workers. And you can really see that in the, so it's a form of insurance. It's not officially in any legislation or anything, but implicitly the government is saying, well, if something like a pandemic comes along, we're going to keep you whole. And if you look at real disposable income, household income, normally that would go up and down when GDP goes up and down. And if you look at this recession, the opposite happened. GDP went way down, but household personal income actually went up. If you look at the trend line from 2019, households actually had, in aggregate, have more household income in 2020 than they had in 2019. So, it was a insurance against the pandemic, and for many households, they got enough to be able to maintain their lifestyle. Now, a lot has been said about this, so they saved a lot of it. I think the saving was perfectly appropriate, because if you're a disrupted household, you're not sure when the pandemic's going to end, so you're not sure how long this thing has to, your check has to last. So it makes a lot of sense that you would save because of that. You're also not sure at that point that Congress was going to appropriate more money in the future to help you out if the pandemic went on longer. And so for those reasons, savings skyrocketed. again, I don't think this is a situation where we really wanted everybody in the second quarter of 2020 to go out and have a party or something. This was you're trying to get through this crisis. So now, as it turned out, Congress did come up with another bill on December 27th, and then more here in March. So I think households will have been kept whole through this whole episode, and real disposable income will actually be above the 2019 trend line for this whole period. And so in that sense, I think ideally you would have kept people right on that trend line. What we really did was go above and beyond that. But that's a pretty good policy for this kind of shock, I think. And then what that's doing is you don't have these households that really got hit hard. You do have some businesses really got hit hard, but we've done what we can to try to minimize the damage from the pandemic, so that once we get all the vaccines out there and hopefully get past this, we don't have this scarring effect that people have talked about. And obviously we're going to have some of that, but I think we've greatly mitigated that problem by being as generous as we have been. Now, some people would say, well, I don't really think we should be borrowing this much money, but if there's ever a time when you're going to do it, it's probably during a pandemic or a situation like this, because otherwise you might get into a depression scenario, and it might take a decade to get out of it. I don't think we're going to be in that situation. We're going to be much better shape as we come to the end of the pandemic here than we otherwise would have been.
Do you think Congress in the next year or two should at least embark upon a long-term strategy to get, the fiscal position of the country and closer to balance? Or what, I mean, are you afraid that what began as an emergency response is being kind of baked into the baseline, and it's going to be that's going to be assumed kind of to be the new normal?
Yeah, I mean, the policy that I just described, that's not something you would do every day. That's something you would do in a national emergency. And there would be implicit pandemic insurance. And I'm sure if there was some pandemic 25 years from now, they'd probably pull out the same playbook. The policymakers in the future will pull out the same playbook and try to do the same thing. But that's not what you need to do on a daily basis, because on a daily basis, it's about improving the productive capacity of the country. You want to have the right public investments that will set you up for success for the long term. You want, and we do have this infrastructure bill, and we can talk about it, but the notion is that, you really want to improve the wealth of the nation. That's the physical capital stock and the human capital stock. And you want the people to be able to get to the right jobs, which are going to be best for them, and use their skills as best they can be used. And if you can get all those things to happen, you'll have a great economy. Those are the kinds of things that you want to focus on day to day. And you wouldn't normally be doing this kind of insurance for disrupted households, except in special situations.
Has COVID changed sectors of the American economy in permanent ways? I saw an interview you did, this was maybe last summer, where you were just musing. You said, I just don't know, but you're musing about the airline industry and just how that industry is going to come out of this, just given the way that people communicate in a different way now than we did a couple of years ago. You just mentioned movie theaters too, and who knows, there's other obviously effects on that. Are there sectors of the economy that you think are just going to be fundamentally different than they were back in the day?
Well, it's become a cliche to say that the pandemic sped up trends that were already in place in the economy, and the use of exactly what we're using here, video chat technology, is something, I don't know about you, but people have been talking about this since the 1970s, as far as I remember. probably 2001: A Space Odyssey had people talking in video chat, right? So it's one of those things where it's easy to sit there all those years ago and anticipate that was going to happen, but it's quite another thing to actually commercialize it and actually see it adopted. So technology adoption is really quite an interesting subject in economics, and it does seem to be very kind of path dependent. And so maybe this pandemic will, I think it has and will greatly increase the amount of video chat technology that we use, and could have an impact on our desirability of travel. Work from home could be, businesses are really scrambling to understand the impact there. Do they really want their workforce to be all remote, or some fraction of it to be remote? How productive would everybody be? This is an issue that was around before the pandemic, but has really come to the fore now, and I think will be a very hot issue in the next 6 months as the pandemic comes to an end. And then you've got universities like Southern Illinois at Carbondale, have to think about how are we really going to deliver education services in the future with a generation that's very comfortable with technology. Is that going to change? Or are we going to insist everybody sits in a room and does a lecture format, which is the traditional way to impart knowledge on the younger generation? So I think there are just many fascinating issues here, but there's no question this has been sped up. And one of the ironies of the whole pandemic has been that the tech sector was already kind of, taking over the world. And then this happened and they got a tailwind, already doing very well. And they got a tailwind to do even better. And so they've done especially well during this pandemic.
Let's talk a little bit about the economy right now. And I saw an interview you did relatively recently where you were, and I'm sure you maybe have tweaked the numbers, but you were projecting that the economy is going to grow about 6.5% this year. With unemployment falling, I think by the end of the year, it's about 4.5%, and inflation maybe a bit above 2%. Is that sort of what your current thinking is as to how the U.S. economy looks?
Yeah, I put inflation at 2.5% for the end of this year, and I don't think it'll fall quite as fast as other forecasters have in 2022. So I think we'll end up with inflation above target for some time, but it hasn't happened yet. The numbers aren't there yet, so we'll have to see if that really pans out. But it sure looks like you'll get this boom in the U.S. economy. I mean, 6.5% growth for a whole year is faster than has been typical for China over in recent years. So that's just a really fast growth rate for the U.S. We're not used to that. I'm sure we're going to see more. We've already seen it, but we'll see even more supply bottlenecks of various kinds. Inability to get the right parts at the right time, and prices moving a little bit more aggressively because of that. All of that's going to happen. These are things that we haven't been used to. I think the period after the global financial crisis was a very subdued growth period for the U.S. economy and low volatility period for the U.S. economy. And so this is going to be a fast growth and probably higher volatility period. And we're going to have to adapt to the new reality.
I saw, I think the official unemployment rate now is like 6.2%, something like that. And I saw Secretary Yellen speak at the Chicago Council a few days ago, in which I thought she said that the real unemployment rate is really closer to 9 or 10% because there's just a lot of people who discourage and aren't actually, looking for work. I mean, how do you see that issue? I mean, where is our jobs market right now as you see it?
Yeah, the key to understanding the jobs market during this pandemic has been the so-called temporary layoff category. In normal times and even during recessions, of all the people that are unemployed, the percent that say that they're on temporary layoff is usually only 10 or 15% of all the people that are unemployed. So the typical thing to have in your head is that the person is out of work, and you ask them, are you permanently out of work or not? And they say, well, my factory shut down, so I'm going to have to do something else. So that type of worker that gets thrown out of a job, we know from the statistics, they have a long slog to get back. They might have to retool, or they have to find a new employer, or whatever happened in their industry probably happened to the other companies in that industry. And so it takes a long time for that person to get back to employment. But this temp worker category is different. That category says, the worker says, yeah, I'm out of work, but I'm still talking to my employer. They're sounding like they're going to start up the factory again in 30 days or 60 days or whatever, 180 days. And so they feel a lot more comfortable that they'll be able to get reemployed. Now, if you look at what happened in last April and May, almost 80%, over 80% of these people, it was a huge amount of unemployment, but 80% of them were saying I'm on temp layoff. And indeed, that's what happened. You got these gigantic, jobs reports in the spring, and that's because these firms adapted. They assessed what was going on with the pandemic. They were able to recall workers, bring them back in. And even today, you've got an elevated number of the unemployed that say they're on temp layoff. So what's going to happen is, as the pandemic comes to a close here, more and more of those people are going to actually go back to their previous employer. If that's all that happens, we've done some back of the envelope calculations. Unemployment will go down into the low 5% range, just based on that alone. And then you've got people that have left the labor force now, which is what Secretary Yellen was referring to. And I think we know a lot of the story behind that. You've got, couples with children at home. Somebody has to stay home with the kids. So that's affecting labor force participation. But now it looks like to me that schools will be, reopened pretty much fully come the fall semester. So I would say that issue will probably go away once you get to the fall, and I would expect those that have dropped out to, if they want to, they'll think about coming back in. I'm also very encouraged by the job openings numbers, which didn't really fall all that dramatically during this recession, and now are close to record levels. So it looks like we have plenty of job openings, and we'll be able to absorb a lot of new workers as we go through this boom time here. So I don't think this is what's really, you have to keep in mind, this is a different shock. It's going to have different feel as you're coming out of this. You do have to get to the end of the pandemic. You have to shut the pandemic down. But once you do that, I think you're going to see blockbuster jobs reports, and you're going to see a lot of adjustment, and it's going to be a very strong economy and a strong labor market.
What is the most significant long-term economic challenge the U.S. faces that keeps you up at night thinking and wondering and worrying?
The global situation with China, I think, has deteriorated in the last decade. The trends don't seem good to me. Henry Kissinger said we're in the foothills of a Cold War. You have China, projecting power in various ways. They sound like they want to be somewhat expansionist in various ways. They lean on a lot of countries. So I don't think this is a good situation. I think when we allowed China to come into the WTO, there was a implicit promise that they were going to trend toward democracy. They were going to experiment with democracy and see how they could get it to occur. And none of that is happening now. They've gone to a dictator for life type model, which, sounds like what it is. I think it's unstable. It's always been unstable around the world. What happens when, this particular leader dies? There'll be some struggle for power or something. So these trends are not good. And it would be great if we get on a better and more even keel. But some of that has to come from China, I think, because they're pressing very hard on wanting to, have a Chinese century, I guess, is the way they would think about it. But it's a dangerous world, and it's a dangerous game to play in this world, I think.
We have a few questions that people have emailed in, and the first one comes from Charles in Hoffman Estates, who wants to know if there's any kind of pilot program or research endeavor that the St. Louis Fed is doing that you're particularly proud of and maybe distinguishes yourself from other regional banks.
We try to do a lot of things. We do try to experiment, and we'll take the ones that are working and accept the ones that aren't working and move those resources elsewhere. But we do have a new Institute for Economic Equity that we just launched in recent weeks. This is an attempt to go further with a program that we had in the past, which was a Center for Household Financial Stability. That center came out of concerns coming out of the global financial crisis. But now I think the world has changed some, and we want to think more broadly about economic equity. I've also related to this. I've done my own research, which I still do some, because I've been very interested in the question of monetary policy and inequality. I think that this has been a understudied subject in macroeconomics, and something we should have more to say on. And so hopefully we can work jointly with our team in the Institute for Economic Equity and our research team to get better answers on how monetary policy affects inequality. The thing about monetary policy and inequality is the views on this run the gamut. You get some people say that the low interest rate policy or lower for longer is enriching the rich. It's making the rich richer by, usually they have the idea that it's boosting equity markets. But you have other people that say, no, you have to keep the interest rates low because you're helping the poor, because it's lowering the unemployment rate. And so I think I want to cry, because as macroeconomists, we don't have a good answer to this. And we need a better answer. And who's right in that? Is the interest rate policy helping the rich, or is it helping the poor, or what is it doing? So I think we got to get better at that.
Lorraine from Carbondale wants you made a reference to this earlier, to comment on President Biden's infrastructure plan, both the kind of the broad thrust of it, and also how important is it to have a sound way to finance it, if you have a view on how it should be financed.
Yeah, I mean, I love infrastructure debates in Congress. I think it's a great thing to think about and to work on, and it's an appropriate role for Congress. I don't think it's as easy politically as is sometimes made out to be. I think there's kind of the idea that, well, if you just put a Christmas tree together and give everybody something, you'll get a bill passed. I don't really think that that's how this works. It seems you've had successive presidents of both parties trying to get infrastructure bills, and they haven't been able to get them. You've also got state and local spending, and if the federal government does it, then the state and local governments don't have to do it. And so in some ways you might not get any more spending than you would otherwise get. It's just a different jurisdiction does the spending. So I think that's interesting. But as a macroeconomist, you want to think about the kinds of things that would really help us over the next coming decades and really enhance productivity in a major way. And surely there are things that we could be debating and doing that would contribute to the long run productive capacity of the economy. So the freeway system, I think, was a brilliant innovation. I'm not quite sure that people that did it envisioned how productive that was going to be or how useful that was going to be. But that's one that had tremendous impact, I think. And there are probably others, and it doesn't have to be, and this bill has a wide variety of things in it. It doesn't necessarily have to be, just roads. That's a success story, from the past, but there may be other things that we can do that would really help us long term and give us a leg up on our international competitors. So I think it's a great subject to be talking about. How to pay for it is also a great subject. These things aren't cheap, and but if you're investing in the productive capacity of the country, that's a great thing to do. The problem is every member of Congress thinks every single thing that they could possibly have is actually an investment, and a lot of it's not. A lot of it's not that useful or has low marginal productivity. So somehow you got to get the debate to be really sharp on the things that are actually going to help future productivity versus those that are not.
Mike from Chicago wants to know what the Fed's role is in the climate change debate. How can it be constructive in this big discussion?
Yeah, great question. And one thing that we've done recently is join the international consortium of central banks that are thinking about how to bring climate change risk issues into supervision of the largest financial institutions globally. And I think that's a great discussion to have. Certainly the ECB has been involved in that, and really all major central banks around the world. So we'll be part of that discussion. We were actually attending those meetings previously, but we weren't official members. So now we're official members, and so we'll be involved in that discussion. The Fed also, there is a line of macroeconomic research which brings into play, brings climate change into play. Those papers, and I guess Nordhaus got the Nobel Prize for this, but those papers just take the climate science as given and then just put that into a macroeconomic model and see what the implications are. I think we're learning a lot from that. And there's a lot more to be done. So the Fed is a good research institution, can be instrumental in helping that process along.
We have a lot of students watching. I wonder if you might have 3, 4, 5, whatever number of books that you would recommend for just the interested layman who wants to understand basic economic concepts. First of all, I might say they might go to the St. Louis Fed's website, because you have some extraordinarily productive.
Yeah. Well, that was going to be my answer.
Okay.
So I think I'm not. There are a lot of great books out there. I guess I'm not going to recommend particular books, but we do try to be useful on this, and we do have our FRED database, for instance, and you can sign up to receive updates from us on the latest economic data. I think for somebody who's interested in tracking the economy and learning more about the economy, it's very useful to sort of see sort of the day-to-day jostling over the numbers. And then we have a blog, the On the Economy blog. That's probably several times a week, and that's since people don't read books anymore, we do it in bite-sized segments where you can get up, you can read the blog for that day, and you can kind of get up to speed on a particular issue in macroeconomics or monetary economics. So I actually think that for a budding economist, that's a great way just to track things, learn about different issues without committing to an entire book by a particular person.
Well, if you had a couple months sabbatical to just explore any economic issue and to just really kind of think it through in an unhurried way, what would you choose?
Well, like I said, I was alluding to before, I actually do research, and I've become a bit obsessed with trying to do a clear and useful model for monetary policy and inequality, where you can make clear statements about, you can understand what's going on in the model, and then you can understand, okay, well, this is how this is going to affect redistribution in the economy, because this is, in my mind, this has become a central issue. And this is, during the aftermath of the global financial crisis, especially when I was in Europe, I would be asked, aren't these low interest rates hurting savers? This is a common theme, and that, there's two sides to the market. There are borrowers and there are also lenders. And these people are trying to save for retirement. Aren't they being hurt by this policy? And I was that kind of, I probably didn't give very good answers to that. And that made me think, our models don't really talk about this in a coherent way. And maybe that's leading us to be, possibly way off in what we're doing as far as what we think we're doing as monetary policymakers. So this has made me want to actually get a model written down for those that want to look at it. It is mathy and technical, but it also has some explanation in there. It's called Monetary Policy for the Masses, with my co-author, Ricardo DiCecchio here. And we have new versions that are more souped up around that. But the good thing about that is that kind of research that I come from is actually lends itself to this kind of discussion. So hopefully we can get a better conceptual framework. I do think ideas are powerful, and get a better conceptual framework for what we're doing and what we're not doing with monetary policy with respect to inequality.
Well, let me ask you finally, how do you like to relax and unwind when you have some free time? I know you're extraordinarily active in St. Louis, many activities and programs you're involved with, but how do you like to unwind? What is a way to decompress?
Well, I've watched everything on Netflix, just like everyone else. But I do like to bicycle, and actually there was a silver lining to the pandemic, because I was able to bike about 3 times as much as I would in a normal year, pretty much every day, sometimes twice a day. And so I really got a lot more exercise in. That fell off during the winter here, but now that we have good weather again, I'm back at it. So that's it's fun, and it's always great to get great exercise.
Well, what about when Twins played the Cardinals? I looked it up, and I knew they played in the World Series, but I guess it was in '87, which was before you came to the St. Louis Fed. So you didn't have to negotiate that loyalty issue. Are you a Twins fan or Cardinals, or how do you come down?
No, very much transplant here. I've become a Cardinals fan. I think that Cardinals are just a sensational franchise, and their ability to stay competitive in many different situations has been very impressive. Of course, for a time, you had Albert Pujols here, one of the great players of all time. And so I very much appreciate the organization's ability to continue to compete. I thought there was a period, and I may have it wrong, but a 15-year period from about 2000 or 2001, or maybe that they won the most games in Major League Baseball. I once calculated that. I thought that's the way it came out. But if they didn't, it was close. And And I think that's very impressive, to be able to follow a team that can be that competitive over that long of a period of time.
Well, I was going to say, people talk about the Cardinal way, but I will say, just in dealing with your bank, there's the St. Louis Fed way too, because we rarely have dealt with anyone as professional and as organized and as efficient as your shop. So you've been a pleasure to deal with. And when COVID eases, we would love to coax you to Carbondale. I know you love to travel the district, but
I'd love to come.
It'd be wonderful to have you meet with students and members of the community and to visit with them in person again.
Yeah, I'd love it. Please keep me on the list.
Great. Well, thank you so much, President Bullard. And thanks to all of you for watching another edition of our series, Understanding Our New World. We will have a video of this interview up tomorrow. Please look at it, share it with friends, and thank you for supporting the Institute and keeping the legacy of Paul Simon alive and well. Thanks so much.